Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, September 27, 2018. We're looking at a daily chart of the SPY or spiders, which is the proxy for the S&P 500. So it was actually an interesting day out there today. If you just look at the close and you look at the daily chart, you would say, well, not much happened, and you would be right at the end of the day. For the most part, the S&P 500 cash index, also known as the SPX, finished up 8 points, about 1/4 or almost 1/3 of 1%. So it was an up day, and that's what it was. So it wasn't a big up day, but it was an up day nonetheless. The Dow was up about 50 points, a little bit less in terms of percentages, and the NASDAQ was actually up much more. We'll get to that in a little while. Let's look at the intraday chart. We'll look at the daily chart. We'll recap my thought process, and we'll go about our business. Before we get underway, let me just take a pause here and continue to thank everybody for participating and making comments under the videos. Please continue to do so. Please put your thoughts down. Get the interaction going. It's good for the entire community. In addition, please hit the like button on the video and share the video with anybody you think can benefit from this information. So I think it's important to take a look from an intraday perspective to see what happened and then move out to larger time frames. And it's all applicable. When we look at the charts, you can apply everything we're looking at to any chart whatsoever. So what I might show you on a 10-minute or an hourly chart can certainly be applied to a daily, weekly, or monthly chart, just depending on what the chart is doing at the time. But let's start at the daily since we're on the daily, and then we'll work down from there and probably back up. We'll see what happens. In terms of the daily, we're above the moving averages. So we closed below yesterday, below the 20, but back above today. It's bullish. So there's nothing technically wrong with this market. So then the question comes, well, why have you been short the market? Again, a little bit of a recap. I was long the market, and the market topped out. I took off the longs. I began to build a short position about a day or two before this spike higher in the IWM. And then when we went up here, I added the SPY and the triple Qs, and I added more IWM. If you've been around these videos for a while, we kind of talked about it day by day, what was happening. So everybody that's been listening and watching these is certainly aware of the positions that I took. But I take profit along the way on the way down because you really never know exactly what's going to happen. So my long-term theory is that I think we've seen a pretty important top in the market. Now, it may not be the top. It may not be the all-time top. That's not what I'm saying. But I think it's an important top. And my work tells me that we're likely to go sideways to lower for a while. How long is a while? Several weeks, maybe even into the end of the year. So that being said, I wanted to have some stake in the game, but I also like to book some profit along the way in case I'm wrong, because think about it, just looking at the daily chart, we can easily, just like we've done each and every other pullback we've had, is continue to take off to the upside once again. So I'm completely aware that that's possible. How will I know where I'm wrong on this trade? Well, right now, here's what I'm going to use in the short run, and then if you have a longer term trade in mind, I'll give you that as well. But in the short run, I'm going to use yesterday's high and low as my lines in the sand. So on the upside, we're using yesterday's high. Let me move the chart over. We'll talk specific numbers so that everybody's on the same page. The high was 292.24. It'll become more clear in a moment when I go to a different time frame. Yesterday's low was 289.41. I'm using that in terms of daily closes. If we close, for example, below yesterday's low, that's going to be bearish. That's going to be negative. We're going to be looking toward the 50-period moving average if that takes place. On the flip side, closing above yesterday's high is important, and if that should happen, that's likely to bring much higher prices and likely to stall what was there on the downside or what my concept was for some downside activity. Closing above yesterday's high, I'm going to have to reevaluate, at least in the short run. Listen, sometimes when you try and short the market at a high or near a high, sometimes it takes multiple attempts. That's the way it is, and I also can be wrong, and I'm fully aware of that. Let me show you what I'm looking at. Let's go down to a shorter time frame. Now, here's an intraday 10-minute chart. Now, let's get our bearings. Where are we? What are we looking at? So right here is everything to the right of that black line is today, meaning Thursday's activity. To the left of the black line is everything before this morning's activity. So you see what happened is we gapped higher and we started trading higher. So what happened? And if you know the way I like to look at the markets, you know what I was thinking here. Getting above there, that's bullish. Closing above here is bullish. And then we even, believe it or not, closed above here and then failed. But I'm going to show you further something else real quick. So when you look at a 10-minute chart, this looks rather dramatic. So if you're trading, for example, weekly options, it can be dramatic. You can make a lot of money, but you can also lose a lot of money on moves like this. So from an intraday 10-minute chart perspective, it is dramatic. But what I like to do is also like to kind of pull back the curtain a little bit and look at it from the audience. Look at it from a longer term perspective. What's going on the hourly chart? Well, there's a couple of things. So I like to tell you that the first thing I look at when I see a chart, the first thing my eye is drawn to is generally the right thing. It's generally what the prevalent thing on the chart is. The first thing my eye is drawn to is essentially a channel here. Now, I understand we spike through the bottom of the channel, we spike through the top, but for the most part, that's the channel. So what did we do today? Here's today's activity, the green candles going upward. What today did was we just went back up toward the top end of that channel, challenging where we filled a gap yesterday. We just went back up to that area, but look what happened. Here's another important price level. I would have had a different outlook had we closed above here on the hourly chart. So do you see where my mindset is? My mindset is more geared toward the longer term because when we focus on the shorter term, and that's why I don't advocate using those very short-term charts, the 1 minute, the 3 minute charts. If you can do it and you're a trader and you can successfully do it, that's fine. More power to you. That's fine. It's not for me because they're too fast and it tends to give me and others, I believe, a skewed sense of what's actually happening in the market. When I look at an hourly chart and I see this range, I see one thing, but I also see another thing. So I showed you the first thing that my eye was drawn to. Here's the second thing. So we still have essentially a bear flag pattern, a bearish wedge pattern. Call it whatever you want, but that's also what I see. So that's thing number two. So we filled a gap. And really, until and unless we get above here, really it's this level here, until and unless we get above and start closing hourly above that pivot high, then I'm going to be thinking that the pressure remains to the downside. If in fact we begin closing hourly above that pivot high, then I'm going to have to evaluate at the time and potentially consider that the SPY is going to make an effort to get up and fill this gap all the way up near all-time highs. So that's what's in front of us. It's tricky. It's not easy. Nobody ever said this was easy, but this is what I am looking at on the charts right here today. Now, before we leave the spider party, we're going back to the daily chart and we'll just take notice of the volume. So the volume was about 59 million shares, pretty much on par with average volume. If you look at the bottom of the screen, you see those light blue and red candles down at the bottom. That's the volume each and every day. The blue represents green days. Don't ask why it's blue and not green. And the red represents a red day or a down day. And the black line running horizontally through the average daily bars represents the average 90-day volume. So each and every day that's recalculated to represent the 90-day average volume. So we had average volume and we were up about 1/3 of 1%. So we looked at the 10-minute chart of the spiders, the hourly, the daily. We discussed it. I think we have a pretty good picture of the spider. You know where I stand on the upside and the downside. We have pretty good near-term bookends or lines in the sand, if you will. Now, let's go over to the IWM because, as we know, this is my favorite market leading indicator in either direction. And what was interesting today is the IWM didn't really even try and rally. When the SPY and the S&P 500 was putting in its rally earlier in the day, the IWM, it tried to rally, but really was not the same, right? Look what happened. There's your rally in the IWM. Here's an IWM 10-minute chart. So look at this, and this is our level that we had identified. And for those of you that are new here, I didn't put this line in on the chart after price hit that line. That line was in the chart long before price came into that line. So you'll learn that if you stick around for a while. But look at the 10-minute chart here and then compare it to what the spider 10-minute chart looks like. So we had quite the rally intraday in the spider, but the IWM was telling us something different. What was the IWM telling us? Well, we know because if you've been around these parts for any period of time and you know that the IWM is my favorite market leading indicator, then it was certainly telling us from a leading indication perspective that the rally in the SPY was essentially a fake out rally, at least for today. I want to point something else out, and these are the type of things that come out of my course at Lazy E-Mini Trader. This is one of those snippets, but really, if you want to get deep into the weeds, you can unpack just barrels full of information like this that can help you in your trading, whether it be entering a trade, exiting a long trade, exiting a short trade, getting in a short trade. Watch this. These I like to call breakdown candles. So this candle here, that represents the candle from, this is a 10-minute chart, but it's yesterday's candle. So it's the 26th is the date. That's Wednesday. The 1550 candle, that's the candle that finished or closed at 3:50 in the afternoon. Now, watch this for a second. Now, I find this fascinating. I don't know about anybody else. So if you draw a straight line across the top of that candle, you'll see that it looks like we closed above that candle and then collapsed down. But if you do the numbers, you'll find out that here's the high of that candle, 168.66. Here's the high, not the high, here's the closing price in the candle, never closing above that number. The closing price is 168.66 on the button. We make a higher high, never close above that number, and the market trades away from that last breakdown candle. That's not an accident. It's not a coincidence. I have buckets full of information like that in the course at Lazy E-Mini Trader. If you want to learn how the markets really work, then do yourself a favor. Invest a few minutes. Take the time to come and check out the course because it'll change the way you trade for the rest of your life. I can assure you of that. While we're on the IWM, we might as well take a look at the 60-minute or hourly chart, and you can see how important the 167.83 level is, or within pennies, whatever the actual figure is that the market is attracted to. It seems to be attracted to this general price zone that we identified, again, before price got here. But this is not necessarily a bullish chart. We're in a downtrend. We talked about this yesterday, the day before. This is a downtrend, and until it's not a downtrend, it will continue to have pressure to the downside with overhead resistance. We're below all the moving averages. The hourly chart is trending down. When you look at the daily chart, it looks like we want to come and at least pay a visit to the 100 period moving average, which is the purple upsloping trend line right here. It just makes logical sense to me at a minimum. Doesn't mean we have to stop there, but to me it looks like the market wants to pay a visit to the 100 period moving average, which it hasn't seen since last May. Now, how about the VIX? So the VIX was down today, and it was down a little less than 4%. So again, it's a hard one to read, I will tell you. The VIX is holding a number, so it's not all bearish, but it's not bullish. We're below all the moving averages. It's really in a downtrend for the most part. So in a flash, the VIX could collapse back down. We did fill a gap. We're holding a breakup candle low. Those are the positives. We're below the moving averages. That's the negative. Can we get any evidence from an hourly chart? Well, from an hourly chart perspective, we can certainly say that this is a bullish pattern. We did close above the moving averages. And when I say it's a bullish pattern, here's what I mean. And this is important, right? So forget this is the VIX. Just think about this in terms of candlesticks on a chart. Doesn't matter which chart. Could be anything. And it could be any time frame for that matter. So we have this big, nice move higher, and then we begin to pull back. And we come back in to test around the low of the breakup candle. Now, we know that this takes place not only because we see it repeat on the chart over and over and over again, and not just this chart, but any chart, right? We see it, but also because I discuss it and point it out to you at least 1, 2, 3, 5, 10 times every single day. So we know that it's going to happen. So you anticipate it. And here's the lesson. It really wasn't a lesson in the VIX. I actually had a different method to the madness in mind. Remember, getting inside my mind is a dangerous place to be. Here's what I'm going to explain. Now, part of this I'm handing to you, and the other part of it is in the course. But here's the point. Now, when you have a nice, big, powerful move higher, you have to expect you're going to get a pullback at some point. Now, we don't know. At some point in time on other charts, you'll see, for example, 3 candles like this, or maybe you'll see 5 or 6 candles like this. That's not the point, but at some point, you're going to see a big power move like this. The candle's going to close, and it's going to begin pulling back. That's where you begin stalking the opportunity. Now, the opportunity becomes active as we get to the low of the breakup candle. In this case, the low of the breakup candle happens to be $11.83. Now, again, forget this is the VIX. This could be any stock or any chart under the sun. It could be a 10-minute chart. It doesn't matter. So you begin stalking price as you begin pulling back to the low of the breakup candle. You're not always going to get to the low of the breakup candle. Now, here's where the course comes in. The market took a certain period of time to get to the point in time in which it reversed. Now, look at this down here. So down here, we're sub 12. So we'll just call it 12. And here, we spiked through 1250. So we'll call it 12 to 1250. I'm being very and more than fair. Now, I don't know about you, but the math that I generally do smells like about 4% from not even the low to high, but around 12 to 1250. That's a little more than 4%. Now, for those traders that have taken the course, they understand that they have to have other reasons to take the trade. Just being at that price level in and of itself isn't necessarily enough. But when you start to put together the reasons that did exist on this chart to take the trade, look at what happened. This isn't days that we got 4%. This is not a swing trade we're talking about. This is literally hours, okay? And you can do this on 10-minute charts. You can do this on stocks all day long. You can do this over and over and over again. This is not the only pattern that's taught in the course that repeats. This is not the only thing that you can and have to look for on charts. That's why I urge traders to take the course. I don't understand, and I'm sorry to do this, but I don't understand somebody that's trying to become proficient at something and doesn't want to invest in themselves. And what traders that take my course realize, and here's where it's completely different than others out there. Not only is the information different, and you can see the postings on the YouTube videos from folks that have and traders that have taken the course. They really do appreciate and understand this is different stuff, okay? But where it's different is I'll actually support you. If you've taken the course and you have questions, you're going to get real answers to the questions. And generally speaking, most of the time, they're coming back pretty quickly. Send me a question at 9:45 in the morning. I'm busy. I'm trading. I'm probably not getting right back to you. All right, let's move it along. I know I got on a couple of soapboxes tonight. I apologize, but I do that from time to time, and so be it. That's just the way it is. So the transports, remember, let's recap where we are. We were making a bullish pattern. It failed. If you don't know why it failed, go back and look at the video from yesterday or the day before, and you'll understand pretty quickly why it failed. Now we're below the 20-period moving average, and we seem to be putting in what could be a bearish pattern. We don't know yet. It's really too early to tell. It's only been a couple of days so far. We made some kind of a bottom the other day. We had, a higher close yesterday and a higher close yet today and higher lows. So that could be a bearish wedge pattern in development. If we get back above the 20-period moving average, that'll be positive. But in order for it to really be positive, we need to get back above the high of the breakdown candle from the 24th. That high happens to be 11,515 spot 12. Other than that, the pressure would be to the downside. And here again, it just looks like it wants to pay a visit to the 50-period moving average. But we've gone over this before, and not necessarily in the transports, but any chart this applies to, which is the longer we hover over the 50-period moving average, if we hover over it for several more days, the less likely the 50-period moving average is going to be good support, right? Because if we consolidate over that level, that's the market's way of indicating to us, at least, or me, it indicates to me that it's building energy to make a move. So when the market makes a pattern, that's money flow, right? So money is flowing in, and it's like a fight between the bulls and the bears, and it's the market coiling up, and it's going to be released, meaning the energy is going to be released in one direction or the other. And a bullish pattern, the energy is released on the upside, and a bearish pattern, it's released on the downside. And just the same, when those patterns fail, the energy still gets released. It just gets released in the opposite direction, but it still gets released. So either way, the energy gets released, and that's what, at least from my perspective and the way I look at things, that's what a continuation pattern is the release of energy that the market built up after consolidating. Before we move on, just take a look at the hourly of the transports, and I think it's worth mentioning, does this look bearish or does it look bullish? Now, I recognize that we got above and closed above the high of this breakdown candle, and then we recaptured it. That could be meaningful for the bear case, but look where we are. I mean, essentially, this is bearish right now, at least from an hourly chart perspective. From an hourly chart perspective, you get above here and close above here, which will be above all the moving averages, and that's different, and that goes back to roughly the same area that we discussed on the daily chart. But I just wanted to point out the hourly chart and what the expectations might be coming into the early session tomorrow. So here are the cues. Let's go to the daily chart. That's not the daily chart. It is the daily chart. Okay. So we had a nice up day in the cues today, up $1.62 or about 0.9%. So interesting where we are in the cues. So we have to talk about this in the cues. Each market and each chart we have to analyze and treat on its own, independent of other charts. We can use other markets as proxies, leading indicators. That's fine. I do it all the time. However, we have to look at this and take it at face value. So what do we have? So we had an up day in the cues. We have the larger picture is we had a bearish pattern developing, right? So we had a down move and we've been going sideways in a bearish wedge formation. But what happened today is, in my book, important. So let me move this over. So here's a breakdown candle. We talked about this last couple of days, and here we are with what we talked about could and might happen actually happened. So here's a breakdown candle high, 185.48. Did we close above that? Yes. Here's your closing price today, 185.83. Here's another breakdown candle high, which is 185.55. Did we close above that? Yes. Is that bullish or bearish? Well, it's bullish. It's certainly not bearish. So here's what we have in the cues. We're above all the moving averages. Nothing wrong with the market. We just closed above an important, in fact, 2 breakdown candle highs. That can't be bearish. It's bullish. There's a couple other components to the story. Am I scared away yet? Not so much. It's the end of the quarter. It's the end of the month. There's stuff going on. There's rebalancing going on. It's a bullish chart. I'm not taking anything away from the chart, and I'm not making excuses because I still have some of a short position left in the Qs. Did I book profit when the market went down? Yes, I did. I explained why I do that yesterday. Today you're seeing why you should do that because you never know what's going to happen. But I do have part of a short position left in the Qs, and I'm happy to ride it down if the market decides to go lower, but I'm also prepared to cover it, but I'm not necessarily going to use this as the only indicator. Yes, we closed above an important level, but I want to see more. If we rip higher tomorrow and I lose more money as a result in the put positions that I have in the Qs, then so be it. I'm willing to take that risk because I'm not 100% sold just yet that we haven't seen a more important high. So sometimes the market will fake out. Remember, trick, trap, fool, and frustrate. Is today a close above and then we close back below and recapture and fall away? I don't know. It's possible. We've seen that before. So I'm just giving it more time. I'm just treating the position I have on with caution. If a trader wanted to follow the rules to the T, they would move out of the position and put it back on if we close back below and had a recapture of that level. There's nothing wrong with that. I just decided not to do that. That's an individual trader decision. Everybody makes their own decisions. I broke a rule. I understand that. They're my rules. I'm allowed to break them. How about the XLF? How's it doing? Now, it was only down 8 cents today, which is about 1/3 of 1%, but it's not doing so well. We talked about the 100-period moving average yesterday. No surprise there. Here's a gap. What are the odds that we're going to fill that gap? I would think the odds are pretty high that we're going to fill that gap. Now, here's something I'll put in your mind. Forget the fact that I may be bearish the S&P 500. I may be right. I may be wrong. I made some money this week on those put positions. I still have some. We'll see what happens. But think about this for a second. Just put that aside. Now, if you've taken my course at Lazy E Mini Trader, you see a trade setting up right in front of your face. We have a gap. We have a 100-period moving average. We have a pivot top. We've been going down for a specific period of time. We have a garden variety retracement about to happen at a specific area. We have time setting up with price. Price is lining up. Important turns come near important prices. However you want to say it, this is a trade setting up right before our eyes. Now, we'll see what happens, but what I'm going to do is identify an area where if this particular price area where I just put the horizontal line at 27.74, if that's hit and we see a sign and a signal of a trend change at around slightly below that price, I'm long the XLF. That's the trade. Now, can you trade it a different way? Can you use options? Can you use some of the exchange-traded vehicles that are leveraged? Yes, you can. Can you use just traditional stocks that are components of the XLF? Absolutely. If the XLF is getting a bounce or a rally off a specific level, isn't it likely that the majority of the stocks inside that index are also headed in the same direction? Yeah, so I would want to take a look at various charts of various financial-related stocks within the XLF. So I'm not saying I might buy the XLF in and of itself. I may, but what I'll do at the time is make a decision in real time on how I want to play that particular price level. It may be in the XLF, maybe it's in a bank stock, maybe it's in a different vehicle, maybe it's with options. I'll make that decision at the time, but I will be prepared. I prepare my trades ahead of time. I will have 3 or 4 different ways that I may want to play this particular trade already ready to go. That's the way you have to run a business. The SOX, the SMH, this is the exchange traded fund that tracks the Philadelphia Semiconductor Index. Anything doing today? It was up 0.6%, pretty much on par with the technology sector. So it's below moving averages, above the 200, below the 150 and 20. Nothing really happened today. It was on par with the rest of the market in terms of technology, at least. So we're just going to leave it at that, and we don't need to really beat a dead horse. We don't need to look at this any further than it already is. So let's go to gold, and here's a downtrend or collapse in gold. So here's what we have. We had a couple of things going on in the gold chart that were very, very black and white. They were very, very binary. So the market was consolidating, and as long as it's consolidating inside the low of this breakup candle, then it's generally consolidating to make a move higher. It consolidated for quite a long time, and the other day I began talking about the fact that coming out of this move, it's likely to be a pretty powerful move, right? Because that energy is going to be released one way or the other. Well, think about where we were the other day. We were at a high of 1215.80 just 4 days ago, or 5 days ago. Now we're at 1186.40. So essentially the energy was and continues to be, I think, being released to the downside. They're going to fill the gap. It's very, very close. The gap is at 1184.20. They haven't got there yet. They're going to fill the gap. And in the process, closing below the low of this breakup candle is not bullish. So this is not bullish for gold. I wouldn't recommend being long gold. I never really recommended being long gold. I've never had a position, or at least not in quite some time, in gold. A couple of scalp trades here and there. There's been some traders that were long gold a couple of times off some tails, off some interesting, daily tail candles and things like that. But for the most part, it's been in a downtrend, and we've been discussing the fact that it's in a downtrend, and it hasn't made a definitive bottom. And until and unless it does, I'm not going to be interested from a longer term perspective in gold. So right here, right now, we have to be looking at filling that gap. And if we fill the gap, they're likely to spike through it by a little bit. That low is an important low, right? So that low happens to be, and this is the tail low I'm talking about, is 1167.10. Any close below that low, and farther downside is coming. If that low holds, then that may be an important low for a little while. And if that low holds, and we go down and we test that area and get down, I'm making up a number, 1180. We get down to 1181, 1178, something in that neighborhood, and we reverse down there, there's probably a nice trade to the upside if we go through another test or a test of that particular tail candle and it holds. There's probably some buyers that'll step in right there, but you have to watch and you have to see what happens, and you obviously have to decide in real time. Crude oil. Anything doing in crude oil? Well, the market's doing exactly what we said that it was likely to do, at least one of the things, which was consolidate up here. And if it did so, it would likely be building energy to get through the breakdown candle high. That's it. Nothing more, nothing less. We've been talking about that for a couple days. First, we said it was going to go test it. It tested it. Now that it tested it, we said if it consolidates up here, then it's likely going to do so to get through it. That's what looks to be happening. So 73 would essentially be your next bogey on the upside. Just using a round number. It's not really ready yet. It's going back and forth. Don't be surprised to come down and fill this gap. As long as we stay above the moving averages, then it's bullish. Now, you really technically want to stay above the last breakup candle low. It's not really technically a breakup candle. It's not a great big long candle. It's not like this breakdown candle or anything like that. But I take the markets one step at a time, and closing below the low of that candle certainly would not be bullish. So I wouldn't want to see that, but I'm aware that there's a gap down there, and they can certainly get down there intraday and close back above that level as well. So those are the options that are going on in the crude oil market right now. It's not bearish. I wouldn't necessarily be short crude oil right here. I think the longer they consolidate here, the higher the probability that they're going to want to get to 73. And I'm not saying that has to be the end. I'm just saying that's the next stop on the upside. And with that, folks, I'm out of wind, so I'm going to wrap it here. It's everything I wanted to and intended to discuss tonight. So I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.